Welcome to The Explainer. Today, we're putting on our equity analyst hats to run a rigorous stock valuation on VSE Corporation, or VSEC, using their absolute latest financial metrics. We're stripping away the noise, focusing purely on the math, and asking the hard question: what is this company truly worth? Here's our roadmap for the valuation. We'll look at absolute value through cash and dividends, the residual income reality, relative valuation against peers, a net asset value breakdown, and finally, synthesize it all for our final verdict. To set the stage here, VSEC's current market price is sitting at a lofty $168.11. And look, this price isn't an accident. It's riding the momentum of an incredibly strong 43.9% trailing 12-month return. Investors are absolutely loving this stock right now. And I mean, the chart has been a beauty to look at. But what is it actually worth? That's the mystery we're solving today. Does the underlying math actually support this valuation, or has the market just completely detached from fundamentals? We really need to figure out if the raw free cash flows justify paying $168 a share. So let's dive right into our first category, absolute value, focusing on cash and dividends. We're kicking things off with the classic discounted cash flow model. You know the drill. We project the free cash flow to the firm and then discount it back to present day using an appropriate weighted average cost of capital. This gives us the unvarnished reality of the company's true earning power. When we look at the data, VSEC generated just over $5.7 million in trailing 12-month free cash flow. Now, the documents don't give us explicit future projections, so we're plugging that modest $5.7 million into a standard 8 to 10% discount rate, alongside a 2 to 3% terminal growth rate. And guys, when you do the math, it points to a fundamental cash flow value drastically lower than their current $4.6 billion market cap. A few million in cash flow just doesn't anchor a multi-billion-dollar valuation in a standard DCF. Okay, next up, we apply the dividend discount model. We want to isolate the cash directly returned to shareholders to find the present value of expected future dividends. The thinking here is, if the broader cash flows aren't propping up the value, maybe a robust, rapidly growing dividend is rewarding long-term holders. Well, this actually illustrates a pretty fragile dividend profile. We've got a tiny 0.24% yield, but it's eating up nearly 82% of their net income through an elevated payout ratio. On top of that, the 5-year compound annual growth rate is just 2.14%, which is barely keeping up with inflation. So the DDM implies minimal intrinsic value contribution, mainly because there's just no room to aggressively grow this dividend without a massive expansion in earnings. Moving right along to part 2, the residual income reality. When DCF and DDM outputs seem this disconnected from the market frenzy, we turn to the residual income model. This framework starts with the current book value and adds the present value of future economic profits generated above the required rate of return. Basically, we're asking, is management actually creating wealth over and above their cost of capital? And the source data gives us a really stark answer. It explicitly calculates a fair value price based on earnings per share of exactly $51.20. This gives us our very first concrete, mathematically grounded anchor for intrinsic value. This model is telling us that based on the actual equity and the earnings they produce, the fair price is just over $51. All right, let's step back and look at part 3, relative valuation against peers. With our absolute value calculations trailing so far behind the market price, we really need to contextualize VSEC. Now, our source documents don't list explicit competitors, so we have to assume standard industrial and aerospace peers to perform our relative valuation. Our goal here is simply to test if the multiples investors are paying make any logical sense in the broader industry. Get this, VSEC trades at a highly elevated trailing price-to-earnings ratio of 343 times. Even if we look at the forward PE, it sits at about 48 times. Keep in mind, mature industrial peers usually trade closer to 15 to 25 times earnings. The market is demanding absolute, flawless perfection to justify this kind of premium. If we look at the business completely stripped of its capital structure, an enterprise value to EBITDA ratio of over 36 confirms the exact same story. The market is pricing VSEC at a massive premium to any sensible peer average. Paying 36 times EBITDA, that's the kind of pricing usually reserved for hypergrowth tech software, not an industrial company with a 3% trailing 12-month revenue growth rate. Let's keep digging. Section 4, Net Asset Value Breakdown. Just to be absolutely sure we haven't missed some hidden stability, we want to find the net asset value, or NAV. We're literally stripping the company down to the studs to understand what the underlying balance sheet is truly worth if operations just ceased today. What is the fundamental floor of this business? The data gives us a really elegant way to calculate this. By working backwards from their stated price-to-book ratio of 2.73 and that current price of $168.11, we can simply divide the price by the multiple to back into the underlying implied equity value on the balance sheet. Doing that math gives us an implied net asset value of approximately $61.58 per share. Think about what that means. It confirms that over $100 of the current share price is essentially just air. It's based purely on future growth expectations, market sentiment, and momentum, rather than any tangible assets sitting in the company's control. So what does this all mean? Let's pull it together for Section 5, Synthesis, the final verdict. Bringing all these frameworks together for our final investment analysis, a glaring discrepancy jumps right out at us. Whether we anchor to that EPS fair value of $51.20, the implied net asset value of around $61.58, or the extreme premium in those relative multiples, there's just a massive gap between the foundational math and the current market price of $168.11. The real strengths of the residual income and NAV models lie in their grounding in reality. They don't rely on wild hopes for the future. They look at what exists right now, today. And what exists today strongly suggests that current market prices represent extreme overvaluation. The math points to a value under $65, while market momentum is carrying it above $168. In fact, our source data explicitly calculates a margin of safety of negative 288.36% based on EPS. Now, a margin of safety is supposed to protect your capital. So a negative 228% margin? That is a critical risk indicator, flashing red and warning investors of severe downside if growth falters even a little or if market sentiment shifts. So as you consider VSEC's lofty valuation, ask yourself, when gravity eventually catches up to the market, and honestly it almost always does, will you be left holding the bag or the balance sheet? Understanding the difference between price and value is absolutely crucial to mastering the market. Thanks for joining me on this explainer, and keep questioning the numbers.